Hey everyone, this is David Wong, and you're listening to a new episode of 2.5 Coins. Today I'm doing something special because I have guests. I have two guests that came to talk about Tradfi, traditional finance or normal finance, whatever you want to call it. If you've been listening to this podcast since day one, you know that the first episode was about exactly that, how payments work in the world, how banks work, and so on, which I think is very important if you're trying to understand cryptocurrencies and you're trying to understand what they're trying to replace or trying to improve or augment or complement, whatever. And that first episode was just, me and my small knowledge. And I think it's a good complement. So if you want to listen to that first, feel free. But if you don't want to listen to that first, I don't think you need it. This is a pretty lengthy conversation that we've had with Xavier Lavayssière and Clement Berthou. And I basically asked all my questions. I had so many questions, and we went over, payments in the world, banks, central banks, clearing houses, and settlements, and the SWIFT system, and Visa and Mastercard, and TransferWise. We talked about CBDCs. We talked about Libra. We talked about regulations. This is basically all of the stuff I wanted to know more about. And I learned so much in this conversation that I'm sure that unless you're an expert, you're also going to learn a lot. So this was really a great episode. So Xavier Lavayssière is an independent consultant that's been doing this since forever, and that's working with central banks and financial institutions all over the world on modern technologies for banks, CBDCs, and regulations, and so on. Clement Berthou is a PhD student at the University of Grenoble in France. At the time where I was speaking to him, I believe he was doing some work in Cambodia, studying payment infrastructures and central banks and so on. And he used to be the former head of network management at the Société Générale, which is a bank in France. So what's interesting is that they actually are planning to do a series of podcasts on their own, and they still haven't started it. I will post more as I learn about their stuff, but they really they accepted to come on my podcast and sort of do a test run and answer all the questions I've had. So it was very kind of them to do that, and we had a very I think it was a 2-hour conversation, and I basically had to stop myself from asking questions because it's an interesting world. And this podcast that you're going to listen to doesn't really exist. Finding the answers to these questions from a person that comes more from the crypto world and is wondering about all of these things is quite hard. And so I try to ask my questions. I try to make sure that we define terms. Maybe in the beginning, it might be a bit hard to follow if you don't know some of the terms. But I made sure that as we continued, we all try to define the terms we were using and explain things from sort of from scratch for someone that doesn't necessarily know all about the banking system. Yeah, so I had a lot of fun, and I think you're gonna have a lot of fun. So enjoy the episode. I guess I started this podcast. The first episode of the podcast was about the financial world and how things were sort of already decentralized, as we like to say in crypto. And we saw that, but it was from my perspective, and I didn't know much about these things. So I was trying to explain these things. But I kind of want to ask you guys who are much more knowledgeable than me, what's sort of the life cycle of a transaction in the real world? Like if I'm Xavier, you're in Paris, right? So if I'm in France visiting, because I don't live there anymore, and I guess I don't know, I want to send you money, I have a French bank account, or I'm buying something in Paris, like what would happen?
So, well, the first fact is, last time I tried to pay a friend because he paid the restaurant for me and I had to repay him. And I tried to find a way to pay him. We tried like 5 different means to pay and make it work. So it means that even in Paris, it's not so easy to make a payment in the end. It's still a mess and you have many options available. And first you have to choose which instrument you use to pay someone. And all the digital forms don't work so well if both don't have the same app or the same system. So last time I practically try to pay someone else, which is a payment to another person, it was difficult. But otherwise, in general, just the base idea is that you have money in your bank account, you're trying to pay someone else in their bank accounts. That's the most common scenario. What you just need is to have an instruction that's sent from your bank to the bank of the other person, and that says that this payment needs to be made. That's the payment part. And the settlement part happen after, and will be the moment where the two banks connect to each other and guarantee that the fund move for you, your bank account to the other bank account. So there are two steps. Payment is the part where you just say, I want to pay this person. And then the settlement, which is the two banks fixing everything and making sure that the money moves, which for regular bank account to bank account payment at the moment takes a few days, but it can be much faster with more recent means of payments.
Why is it slow? You say 2 days? That sounds like, why are they taking so much time to settle by payment?
It's not that slow, actually. I mean, that's one point I will actually bounce on regarding, I would say, the settlement. But just first, I will go back to the payment topic, because I think the distinction made by Xavier is very interesting. Because, like, yes, on the one hand, you have the payment, and the first mistake I would say to do when you're actually studying payment is to believe that all the payments they are the same. And indeed, if you are actually talking about a remittance payment, is going to be different than an e-commerce payment, going to be different from a domestic retail payment. And then even if we talk about like similar type of payments, typically a retail payment, in some countries you will not do it the same way. Like in Cambodia, if I want to go downstairs and now buy like a bottle of water, I will use my phone and I will scan a QR code, and there will be a commercial money settlement, or commercial bank money or central bank money, but there will be like this settlement triggered by actually a QR code solution. Tomorrow, if I go in France, I will use my card instead. I go in Brazil, maybe I will use actually the boleto. In Germany, I will use the Giro card. So actually, the payment instrument is very, very tightly connected to the retail habits, and I would say what people used to do or feel good about doing.
But by the way, just to define some terms, but retail is like someone buying something else in a shop. Is that how you define retail? Like real people?
Yeah, I would say that it's business to consumer transaction.
Okay, and remittances, the way I've heard it being said is like when someone sends money back home, but I'm not actually sure if that's the definition of.
No, that's right. Typically, if you are from a certain part of the world and you go to work, for instance, in another one, it can be cross-border and can be as well domestic. You have actually remittance flow when you send back your money to your saving account in your home region for yourself or for your family. It can be domestic because, for instance, one of the largest country in terms of remittance is India. You have many people actually from the eastern part, for instance, or the southern part of India that go to Mumbai or to Delhi to work, and then domestically they send back money to their family, or cross-border with the topic of the diasporas typically.
One aspect of remittance is that you don't have a counter part of the trade, right? When you pay for something, you have something you buy and you get this object in exchange of the payments. For remittances, you sending money and maybe you get love in counterparty, but not directly as a result of the payment.
So yes, the settlement can be. That's definitely one of the pain points that has been actually, I would say, attributed to the correspondent banking, because before actually trying to understand why it's slow, it's maybe important to understand how it works. So when you have a settlement, a domestic settlement, I would say it's quite easy and straightforward. What we call domestic, it's basically when we deal with a single monetary area. So you are within the United States, USD area, or you are within actually the European Union, so you have the Euroland, so you have like the settlement in euro, and basically you are in such monetary spaces. Worst case scenario, I would say or highest case scenario, the payment go through the book of the central bank. So you will instruct a bank, this bank will debit your account and will instruct, for instance, the central bank to debit its own account, because why the central bank is central? Because at the end of the day, every commercial bank is supposed to have somehow an account relationship with the central bank. And so the central bank, at the end of the day, in its balance sheet, will debit some bank account, credit some bank account, and make money circulates like that. And at the end of the day, it's like a pyramid. It will go up the central bank, and from the central bank onward, the debit, I would say, trend inverts into credit, and then the credit go down the line down to the beneficiary. So when you are within like an economic space, a monetary space, sorry, it is quite straightforward because you have the same set of rules, a single regulator, banks, I would say, regulated all the same. You have payment infrastructures, so basically system in or developed by the central bank or by another entity, maybe as well a joint venture of a private sector entity, but making this, I would say, accounting movements quite straightforward, quite easy, quite smooth. So the domestic payment is, and you see it in the United States recently, and with FedNow typically. FedNow is actually an instant payment system settling in central bank money in the book of the Fed. It's taking a couple of seconds, and a payment can fly from California to New York City in no time.
Oh, something I find funny on this is I think it's wild when you study this to realize how much banks don't trust each other. So you imagine that they are all some sort of, a similar kind of people, organization, and so on. But they are very, like each bank could be bankrupt in the next day. So they don't trust at all each other. And how they move funds has been historically really complex to do because they don't trust. And so that's why there is this pyramid and the central bank. The central bank is sort of being the ultimate guarantee and the trust person in the middle for all the banks to work together. So so you need this role to make sure that payment can go smoothly from one bank to another, and then there is no risk for not being paid at some point.
Yeah, that's a very good point, actually. I mean, if we go to the definition of money, a technical definition of money is debt, basically. So it's a transfer of IOUs. So do you want to transfer debt over the central bank, or do you want to transfer or to accumulate a debt in front of another bank? And it's basically the difference between a ACH system and a RTGS. So ACH being the automated clearinghouse, and the RTGS being the real-time gross settlement system. I mean, when you deal with a ACH, basically you are for the time of the settlement cycle, you are exposed to the capacity of your partner banks, of your fellow banks, to pay at the end of the day or not. While for RTGS, you're actually transferring hard, I would say, central bank money, central bank liquidity from an account to another, but there is no credit risk, but the risk that you take over your central bank. And by definition, in its own currency, a central bank cannot bankrupt. Technically. So basically, I fully agree with Xavier. Like there is this idea of, I have debt, but which debt am I choosing? And the one of the central bank, the safest one, or am I accepting to take risk on my fellow banks to save liquidity, but exposing myself a bit more to the bankruptcy of another partner?
Well, so what does it mean when a bank goes bankrupt? Like, do money just get burned and like disappear from the system, or?
We had an example recently when we had the Silicon Valley Bank getting bankrupt. So in theory, banks have a lot of assets that compensate all the liabilities they have. So when it goes bankrupt, there are different steps, but the first step is it cannot pay at the moment someone, and so it lacks liquidity. And then we realize that it might lack assets compared to what it needs to pay, or not have the safety margin it should have. And what happens in the US, but in most jurisdictions, is at some point the government step in and stops everything. We can reclaim at that point some of the money that has been sent away, and we repay in order everyone that needs to be paid. Normally, when it goes bankrupt, bankruptcy is actually an orderly way of doing things. Like the worst case is like someone just disappear with the money. Bankruptcy is the opposite of that. Bankruptcy is, there is a lot of rules and how it happens, and for banks is particularly controlled to make sure that everyone gets repaid. Of course, I know that in France, at least the state gets paid first. So if you have taxes and so on, they get among the first to get paid. But then everyone that has liabilities should be paid over time. And as you know, for retail users, you have some insurance that protects you. So even if there is some asset missing, the government will step in and repay everyone up to a certain amount. So that will happen in a really orderly manner when it goes bankrupt.
I was also thinking in terms of like total money in circulation. Like, if we're in Europe, there's like some euro like vanishes out of nowhere. But I'm guessing that it's just that some people didn't repay the bank, so the euro didn't disappear. They just exited the bank, and so I don't think there's like any like euro being burned in such an event.
No, but you have some liquidity stuck. So if we think about the structure of a balance sheet, somehow a commercial bank is what? On the asset side, you're supposed to have quite illiquid asset. So you will have actually long-term asset. So basically bank loans that the bank is actually expecting to recover in 10 years, 20 years, 25 years, and so on. On the other side of the balance sheet, on the liability side, you have at-site deposit. I'm oversimplifying it, but that's basically and the result of the credit itself. Because when they create a credit, you have asset side, you have a new asset, and you have actually a new deposit being the liability. So you have on the liability what we call money. Liability is basically the component of M2. If you look at the monetary aggregate, this is what we call money. When you have an account with any bank. You have tomorrow, like you have an account, David, I don't know, in JP Morgan, Citibank, Wells Fargo, whatever. On your phone, you see a balance. This is actually a liability of the commercial bank. Then what is going to be the bankruptcy? To agree with Xavier is when actually the bank, because what is a liability is the promise the bank is making to you to make you, enable you to transfer this liquidity at any time upon request. So they should have at any time on the asset side sufficient liquidity to respect basically your customer, the promise they made, and so transfer the money. And when the bank is bankrupting, you have actually a challenge on the structure of the balance sheet because on the asset side they have illiquid asset, on the liability they might actually have exigible or outside deposit that they cannot respect anymore. So the money doesn't disappear in itself. The balance sheet is still there. You still have X million or billions actually of assets. It's the same in liabilities. It's just that somehow the liability is actually stuck because like the bank has no mean to liquefy its asset or in the interbank market or basically by actually I would say liquidating the loan somehow.
Just liquefying would be like selling some stocks to like convert it into cash, for
No, it
example.
might be, for instance, if you think about SVB, typically the balance sheet on the asset side, yes, they had like a lot of T-bonds. So basically, the best debt you can find on the market, because we're talking about the debt of the US Treasury. In this case, usually you have two ways to liquefy actually this asset. First, you actually use it as a collateral on a kind of it's kind of a pawn shop in the interbank market. So SVB borrows cash, but actually puts the T-bond as a collateral on the interbank market. And when they pay back, they get back actually their asset. That is the first thing. And the second thing is, of course, like liquidating, as you say, go on the secondary market and sell these bonds to get cash instead. And when in the case of SBB, the problem was the fact that on the asset side, the T-bonds that they had been issued actually by the US Treasury before the interest rate hike. So basically, the value was actually not under the par. While actually at the same time, because like the solidity or the liquidity of the bank was at risk, no bank was actually willing to lend back to them, even on the interbank market, even with a very good quality collateral. And at some point, the machine got stuck.
Maybe to say in simpler manner, back to your question, which is if money is created or not. Something that has to be understood is that money is every time, every hour created and disappears. Like you have some base money, the cash you have in your pocket, for instance, doesn't move so fast, but everything above is creating depending on demand and so on. And so it's just a question of the monetary policy of trying to ensure that this amount of money that is all created and disappears is in a reasonable amount. That's what is necessary for the economy to function. The best analogy is blood, right? You have a certain amount of blood in your body. It's necessary for everything to circulate, oxygen and all the nutrients and so on. So your body is always maintaining a certain amount of blood. It doesn't matter. It has no absolute meaning by itself. What's important is that there is a right amount that makes things work. But when bank goes bankrupt, the only thing that we try is not just to write off anything, just to make sure that we unwind everything that was open in a sense. It's a lot of open books, and go back and to make sure that it's all in a orderly fashion.
So yeah, I think we took an interesting detour on this first topic of the life cycle of a transaction, but I think these things are interesting, and actually I want to go back to that, but maybe in a bit, because it's sort of like for a lot of people, like the mental model of a bank is that the bank has cash in a pool, and then when someone puts, deposit cash, then they'll just put that cash in their pool, and when someone wants cash out of the bank, then they'll just send that cash somewhere else. But there's always like, if the bank has like $5 million of deposits, then it has $5 million in cash somewhere, which is not the case at all, right? It's just a database, and not even a database of like, this is how much cash we have. Like you said, just a database of like liabilities, and the cash might be in a different form in different types of assets, and then it's not really clear exactly how much the bank has, and it gets harder and harder.
No, it is quite clear. It is quite clear. Like I agree with your the overall definition. Like a bank indeed does not actually has to, I would say, collect cash in order to lend. The lending is actually building up the cash position of the bank somehow, if you think asset and liabilities. But there still is a clear vision of what is on the balance sheet, because at the end of the day, the sustainability of a monetary system is tightly related to the fungibility of the balance sheet. If you think about, because now we are in a two tiers banking system. You have the central bank on top, and then you have actually the commercial bank, and the commercial banks are distributing basically the money through the balance sheet. Before, like you could consider, for instance, mono banking. In mono banking, you had actually just one balance sheet, being central bank and commercial bank. But now in a two-tier banking model, you actually need all the economic players to understand that when they have a JP Morgan USD on their account, typically David, and if you want to transfer to your friend having like an account with Wells Fargo, Citibank, they will believe that actually the liability they have is as good as the one that you've got, and this belief is key, because at the moment you stop believing in your bank and you stop actually trusting the quality of the balance sheet of your bank, then you have a bank run, because everybody feels that the what they got on their phone is actually at risk, and so they want actually the deposit to be somewhere else, and of course then you create a self-fulfilling effect somehow. But in order to avoid this, and as Xavier said, you have many kind of regulatory instruments, all the macroprudential ratios, basically, all the potential guarantees over deposits. For instance, like in France, if your bank collapses, you're supposed to be guaranteed up to 100,000 euro per account with a given bank. So that's these kind of mechanisms are meant to ensure that there is this fungibility. On the one hand, via the supervision of the bank, and on the second hand, with like emergency mechanisms, basically.
I think in the US it's like FDIC insurance, which is like also up to like 100,000 something. But so I sort of want to go back to this life cycle of the transaction thing. You guys mentioned a term that always confuses me. You were saying like, and I guess we also never defined central banking, which I think we should do next. But before we do that, I have two questions. Like, first, do we have to use central banking? Can I send money to your bank without going through a central bank? So just bank to bank. And also, is that what you guys called ACH? Like I constantly hear this term of like clearing houses. It sounds like this RTGS term is really reserved to central banks, for central banks. And it sounds like ACH is reserved for like not central bank stuff, but like I'm confused. How would you explain that to me?
So basically, for the ACH, we can take a very simple example. Let's assume that you, David, and you, Xavier, we are actually the three of us. We are banks, okay, and we want actually to send each other payments. I want actually to send 1,000 USD to a customer of yours, David, and you, David, you want actually to send 1,000 USD the same day or during the same settlement cycle to a customer of Xavier. If we would have used actually a RTGS, it would have been 2 transactions, because I would have sent you like the payment, first settlement in the book of the central bank, and then subsequently using this liquidity potentially or liquidity you already had, you would have actually sent the 1,000 to Xavier in the 2 settlement step. Okay, 2 times we would have used actually the infrastructure of the central bank. With the ACH, there is no such a need. I actually introduce the transaction in the system. You do it at the same time with actually your customer in favor of Xavier's customer. And at the end of the cycle, the clearinghouse will net all the position.
Who's running that clearinghouse? I guess that's what I'm confused about.
It depends. So if you think about the typically the United States, you have basically the if it's NACHA, if I'm not mistaken, it might be actually a private company which is actually owned by a consortium of commercial bank, if I'm not mistaken. Then if you have like in Europe, typically you have actually it's very complicated in Europe because it's I would say a legacy of the I would say former, each country had its own currencies, hence actually they all migrated to euro and they're now interoperable. But if you think about Cambodia, where I am actually now, the ACH is run by the central bank. So it depends. It can be or the central bank or a consortium of private actors regulated by actually the central bank and supervised. And so sometimes, like in India with NPCI, it is a joint venture between the central bank and the association of bank in India with NPCI.
And is RTGS always a central bank thing? And is Cambodia running the ACH by the central bank because they don't have an RTGS? How am I supposed to think about that?
No, it's an excellent question actually. You can have an ACH without an RTGS because RTGS is also the capacity to send immediately central bank money. In Cambodia, there is no RTGS if you think about it, but there is a tool to settle end-of-day positions in central bank money in the book of the central bank. But there is no live system yet working like that for interbank transactions. But if you think about most of the RTGS are actually run by the central banks. I don't know every country of the world, so maybe you have some exception. And for a long time, Canada was an exception because they had no RTGS. It was links, and it was run by Payment Canada, which was a slightly different entity, not fully central bank owned, if I'm not mistaken. But usually, I mean, if you look about the United States, Fedwire is run by the Federal Reserve in New York.
So it's not FedNow, because you mentioned FedNow earlier. I thought that was the RTGS, but is Fedwire the RTGS?
Fedwire is the RTGS, and FedNow is the instant payment system. So basically, it works like an RTGS. So it is still a settlement in central bank money. It's still instantaneous, and it still requires the direct participant to have an account directly with the Fed.
So what's the difference?
Actually, it's more in terms of user at the end of the day, because RTGS, it's more like a institutional to institutional. While if you think about the FedNow, there is this customer promise as well, and you see that the Federal Reserve, when they launched actually FedNow, they were actually communicating a lot on the communication platform, and you have actually the possibility behind to develop. Basically new products. And if I'm not mistaken, there is also the idea of technologies, because instant payments, they are more recent, so they're already up to the ISO 20022 norm, while the RTGS is actually a legacy system for most of the central banks. So they still actually have to drive this transition. But at the end of the day, the settlement part of both the RTGS and Fedwire, or basically the equivalent in Europe, TIPS, is as an RTGS basically.
Maybe let's define RTGS. It's like real-time global system. Is that
gross settlement?
Gross settlement. Okay, real-time gross settlement.
Just maybe to take a step back is, as I think we have seen, is the base step is just you need something to settle between banks, and you need at some point someone to step in and facilitate this transaction, because still they don't trust and they need someone that facilitates this. And that's how a lot of these systems have appeared, and why central bank exists in the first place, is to facilitate operation between these banks. That's part of the role of the central bank. Another part is the monetary policy, but the first part is just facilitating these payments.
And a central bank is always the government that runs it, right? It's never private.
Usually a public entity that's somehow independent of the government, because especially for the part that is monetary policy, You want to avoid to be the same person as the government, because the government wants to spend, especially if it's a democracy, it needs to spend to get elected again. And even if it's a more authoritarian regime, it's good to spend and to show that you do things. But for money to work, you need, on the contrary, for the money to be quite stable. So there is always a tension, because if you use the creation of money to spend, you make everyone happy on the spot, but then everyone is not so happy of the money losing value over time. But just so we have seen all these systems. So RTGS is for the big transaction between the banks. Fast payment system is usually for small, fast transactions, but same idea, sort of. And as Clement said, is also a new generation, sort of. So instead of having all this new, we just use the opportunity to create a new one. And central bank digital currencies are the same idea, the next one. Like, what can we do a bit new that adds? But what's important is, like, all of these systems, they pile up a little bit, and probably it would make sense to rationalize and remove some of the old, but that never happens. Never in the history of payments, one system is dropped for the moving to the next one, because there is always people that are plugged to it. It works as it works, and so we just pile a new system. So it works the same on the user side. You use more and more. We had only the checks and banknotes, and now we have all these systems. And behind the scene is the same. We pile all these systems, and there is new and new options for the payment to be achieved between the two actors.
All right. So in the crypto world, you're telling me, like, we see all these modern cryptocurrencies, like it's faster, it's more secure, like whatever. And it's like Bitcoin is still here, and people still continue to use like older cryptocurrencies. So maybe that I see the same stuff happening.
That's something that fascinates me in crypto, because some of the excitement of crypto is just starting from scratch, right? When you design Ethereum at the beginning, you start from scratch and you're super happy because you design everything from zero. Same when you started with Bitcoin. And now we're already in a stage, it's been more than 10 years, crypto exists already, where the legacy piles up. Like, we know that the EVM on Ethereum was poorly designed at the beginning and needs to be improved a lot. And so we need to remove some opcodes, but it's challenging because some people still use them. Same, and Bitcoin has been really conservative on this, like they have tried to make, you can still move a Bitcoin from the early hours and still the system is still full compatible. So it's a bit, and we are adding new chains that's supposed to be better on different dimension, but then so everything just piles up, and we are already 10 years into crypto in a pile of things that we should probably remove at some point, but there are still people using them, so we don't.
It's horrible. So in the first episode of that podcast, I was sort of presenting the 2 days financial world and saying it's extremely decentralized. We have all these central banks and path between banks to central banks and so on. And that's why it's kind of like, and now you're telling me we have all of these different protocols that also banks can use and central banks can use. And so it makes everything very complicated. And so crypto came and was like, okay, we're going to simplify everything. We're going to have a single database. It's run by many people, but it looks like a single database. And everybody's going to use the same database. It's going to be super simple. Retail, business and government, whatever, they're all going to use the same stuff. We're not going to defer payments. Everything's going to be instant. But then the exact same thing ended up happening, and all the legacy stuff ended up piling up. New projects ended up coming, and now it's this huge nightmare of a web.
No, but there's something regarding like the intermediation, maybe with crypto or with payments. At the end of the day, is like when you use actually a mean of payment. Most of the time, you want it to be like as transparent as it can be. Like, you don't want to think about what am I doing actually when I'm paying. You want it to be simple. You are already focusing so much of your attention over like the economic act that you're actually doing. You go to the supermarket, you choose your products, and you want actually at the end of the day the mean of payment to be as easy as possible. A note in your pocket, a card in your pocket, a flash on your phone, something easy. And basically, if you think about the genesis of crypto, it was not easy. It was something dedicated to a core specialist, I would say, and the access was requiring to have a wallet directly actually on the ledger, and it was actually challenging. And then, what was the role of these intermediaries? Think about Binance and all the similar actors, is to make the use easy. Basically, it's to some kind of through processes and user interfaces to make something that can actually look difficult to access for day-to-day users to as easy to use as any kind of system. And basically, the role of commercial bank is also this, if you think about it, not only through the balance sheet, but through like the mean of payments that they actually distribute to their users and make actually the payment occurring as easy as possible. There's this idea of user experience, which is key actually when you think about payment, because you have to be able to use it anytime without actually thinking about it.
So basically, everything is complicated. We're still trying to understand the life cycle of a transaction, and we're sort of going in different direction because it turns out it's hard to explain how a transaction really goes into a system. Like it goes from one bank to another. There's different types of payments, so you might go through an RTGS or an ACH. You might go through a central bank, and all of these things. What I'm wondering is, you guys said some words. Well, I remember, Clement, you were talking about like the path to the top of the pyramid, where the top of the pyramid is a central bank. Xavier, you were talking about instructions, like a bank instruct another bank. So these are interesting to me because like they touch on routing, like how do we find a route from 2 points in this? So in this life cycle of a transaction, we're still trying to figure out how to go from one bank to the other, which you said might be easy if you have a central bank, but I'm wondering if that's always the case. And the instruction is more of a technical thing. It's like, how do banks communicate with one another, or how does a bank communicate with a central bank? Yeah.
But you're touching a very important point here, David. So basically, when we discussed about the top of the pyramid, like the hypothesis that we took was the easiest one to say we are part of the same monetary system. So, for instance, I want to make a transfer from my French account to Xavier's account. We are both French, so it's very easy. I have an account with a given bank. Xavier has an account with another bank. It's okay. But if tomorrow, David, I want to actually transfer your money, there is a transfer from a Eurozone to the United States. So not only you have to switch from a pyramid to another through a FX transaction, but as well through a payment infrastructure transaction. You have to switch from European liabilities to actually US liabilities. And to do so, you cannot rely on any payment infrastructure. Central bank operated the payment infrastructure, because in this case you jump from like the perimeter of the ECB to the perimeter of the Federal Reserve, and to do so, banks as simply as that, they just have account with each other. So my European bank will have an account with a US bank, a USD account. This USD account will be actually used to process the transaction on behalf of my bank on the US system, and ultimately reach your bank. Okay, so let's take a very concrete example. I might have an account, for instance, with Le Crédit Lyonnais, a random bank in France. I just selected. You have an account with you're from Lyon, and so basically, and you have an account, for instance, with US bank in the US. In this case, Crédit Lyonnais will instruct its correspondent bank, maybe it's Citibank, for instance. So Le Crédit Lyonnais has a USD account with Citibank, and Citibank will debit this account, debit its account with the Federal Reserve via Fedwire, and then deliver the credit to US bank for your bank to apply it on your account. And so this is correspondent banking. And how LCL is actually instructing Citibank to debit this account using SWIFT, the messaging system.
Yeah, maybe to clarify, I think you put it greatly, David, that there is two levels. One is the financial level, where there is this routing and you need to have different institutions that have already a contractual relationship, and they agree to exchange assets or liabilities among them. So that's what Clement just described. And underneath, you need to have a technical communication message system. And here it's exactly what SWIFT was designed. So SWIFT is a global company. What's interesting, it's a cooperative that belongs to the bank. So it's a sort of really socialist approach to it, where all the banks put their resources together and created their common organization that's not supposed to make money on its own, but just ensure the communication. Part of it is having encrypted channels of communication between the bank, so that's part of the role. Slowly, they used really their own system for a long time, and slowly they're moving to more open web technologies. One part where it's the most discussed and there is a transition at the moment is the format of the messages that are sent, which is how the information is put together, where there's this new standard that everyone talks about in finance that's called ISO 20022. What's fascinating, it's a standard that has been designed 20 years ago and it's still not fully implemented and still not everyone uses it. But Swift is the main actor that's creating the pipes and facilitating everyone to use this format. And this format, for the people that are a bit technicians, is just an XML file with a sort of meta dictionary. So every usage, you can define your own sub-dictionary depending on what you need. And here you see how complex it is, because you cannot just say, well, you have a field of like the payer, the payee, the amount, and a reference number. That's it. No, because every payment is different. You need different fields. You need different information. And so it expands. You have the address of the person you pay to from. You have many different information on the bank accounts.
It's so crazy that we still have XML.
And that's the novelty. That's finally we have XML, because before it was proprietary standard. That's the modern version that took 20 years to adopt because it's slow to do.
Wow, that's so interesting. So I guess this is very good for job security. This is very good for us. Like we're never gonna be out of a job. There's a lot of things to study, a lot of things to do, a lot of expertise to gain.
But it's interesting to understand this past dependency of things, right? It's not because people are particularly slow or not interested in. There is part of companies that are incumbent and that slow things down because they gain advantage from how things work currently. That happens. But it's not only that. It's like you have so many actors that need to coordinate and agree and move forward that it necessarily takes time. So there is no way that it's easy.
And you cannot stop payments, right? Like, for instance, when you migrate, and that was the case in 2023, actually, when the European Central Bank in March migrated to ISO 20022, they did it in a big bang. So basically, over overnight, they actually changed from this previous format, which was actually the proprietary format, the historical legacy one, to ISO 20022, and everything had to be working the day after, because if you don't have a RTGS, you lose actually the backbone of all an economy. Because if tomorrow you cannot make payments, and because via the RTGS you have like high value payments being processed, treasury payments for companies, financial market related payments, so it is actually a critical infrastructure. Even, for instance, if you think about the global financial crisis, when the central bank has to inject liquidity to intervene and actually prevent an ongoing or tackle an ongoing crisis, I would say, they use the RTGS. The RTGS is actually what then is going to make the liquidity liquid. And so you cannot imagine having a disruption of the payment system, even when you're actually migrating. And when you migrate, not only the system has to be able to migrate, but all the participants of the system, they have to migrate at the same time.
It's a forced upgrade.
Yes, it's kind of the same problem. Like they avoid to have any hard fork. So you need to have everyone on board to make sure that there is no hard fork of the system at some point. Well, there is a hard fork, but no breakup of the chain.
Right. And a forced upgrade is like, okay, we don't want to have like legacy systems in place, right? Like you're forcing everyone to upgrade. So you don't have to like continue support for these older systems. But yeah, it made me think of like you have different, like these kind of things exist everywhere. Like I've seen it with TLS, where like you always have to support older browsers and older machines and older middle blocks. And so TLS sort of evolves in this kind of Frankenstein protocol. And I've heard the same thing, like I always thought it was funny, but like Netflix has like so many clients because people have like old TVs that used to have Netflix on the TV. And so they have to support all sorts of old protocols and older clients. And so Netflix has become like this, like it's funny, right? Like Netflix has become as complex as the financial system, maybe, like who knows, just because they have so many different clients and older clients to support.
It's interesting because the example of Netflix, because it's a business choice, is how much you want to move forward, leave some things behind. You see it with Android, with browsers, with all these things. Like some companies take the choice of moving forward and sorry, your Apple device is too old and you're not going to get this upgrade and too bad for you. And from now you're stuck in how things are. But when you're working with payments, you cannot have that. You need everyone that's part of the system to be still able to proceed. So yeah, it's a fantastic analogy, the one on Netflix, because probably it's a company that's a bit in between and try to keep clients and satisfied, probably cuts sometimes some corners, but has to make some choices.
Cool. So maybe, okay, we've seen how things work, and you mentioned Swift, which to me was interesting. So it sounds like Swift is like an international way of like understanding who to talk to.
Yeah, I'd say that, yeah, to come back to the question of Swift, I'd say that Swift has two components. The first one is standardization, and the second one is about security, safety. That's the promise behind it. And behind like the idea of standardization, you have as well the idea of a network effect, because you have many participants. But I would say that this is kind of a consequence, because what happened in the 70s, you had actually an increasing of cross-border payments and no infrastructure to make sure that these cross-border payments were timely processed and processed without mistake. Because what is at the end the objective for a bank when you have correspondent banking relationship is, for instance, I have an account with you, David. I can send you actually a telegraph, or I can send you a text, or worst, I can ask my back officer to actually call you, your back officer, and instruct the payment like this. And you will actually, I will do something on my ledger, on my mirror account, to mirror what you are supposed to do. Your actually back office will process on your ledger, on your accounting ledger, the transaction that is expected, and then we try to match the two. If there are mistakes, we solve. But the more mistakes, the more difficult it is to follow up, and the more complicated it gets. So Swift came with this promise of standardizing, meaning that when I send one type of message with this kind of information in this actually part of the message, you will understand without any doubt that this is what I actually instruct you to do, and you will do accordingly. So this idea of standardization enabled to scale up, basically. That was this idea in the 70s. And security, because now the idea behind Swift is to ensure that it's hack-proof, basically a network, and that basically the hack-proof and bug-proof, because they have to be 99.9% or 100% of the time actually available to their users. When they do not, they have to have actually backups, because you cannot, once again, prevent payments to happen. And you cannot be hacked. So you don't, as a bank, the last thing you want is your Swift terminal to be hacked and to instruct payments on your behalf. That's what happened with the Bank of Bangladesh, typically.
Yeah. The two things. One is I have a story about the problem of standardization and so on, because one of my first internship was I was working for the European Investment Bank, and they were receiving like many payments every day from everywhere, all over the world, and they were exactly Swift payments. So they have this message that was coming from Swift, but now they need to know for each payment to which lending contract it corresponded. So it was countries mostly. So a country pays you like, and it's huge amounts, like it pays you like hundreds of thousands. And now you need to find where it's who paid your debt, and then reclaim the one that didn't pay. And because of the format, the way it's done, it was not functioning well, because sometimes they would put like the name of the country or the project, or even the contract number. But because the fields are limited in numbers, sometimes the contract number will be cut. And so we'll just have the beginning and then the amount. And the amount was never precise, because sometimes they had to exchange the currency. So it was not exactly what the amount we were expecting. So there was some margin, and sometimes there were mistakes. So what I had to do is to create a rule-based system to try to match all the payments we were expecting for that day and all the things. So that shows you how difficult it is, because you have the SWIFT that's between the two banks, but then you have internally the system of the bank that needs to pick up these messages and make sure that they put the information at the right place. And here for the landing, it was to make sure that we knew that this one had paid, this one had paid. And
right, SWIFT is only a very small part that is like the routing part. Like the way I see it is that it maybe works like DNS. Like when you want to like reach someone, you just ask, like sort of like you ask like a DNS server, like how do I reach this address, or and they'll tell you like you can reach this IP and this is how you go. So maybe like you talk to Swift and you're like, how can I reach that bank? And they'll tell you like, talk to that bank first and then talk to that bank. Is that sort of the way?
It's a bit more than DNS because you have the DNS, but you have also the message itself. So it's a bit like the, I don't know, a TCP message, and you have the format, or even a higher level, like that explains what's the format of the message you send.
Oh yeah. So it's DNS plus the format of the message for you not to talk to these like resolvers, but to talk to the other banks, right? So it's a standard, right?
Exactly. And now it's a problem. And now we get to the heat around Swift at the moment is that currently we tried the internet infrastructure to be neutral and be only protocols that everyone can use. But for Swift, that was the intention. But recently, not every country is still on board. And recently, Russia was partly cut off Swift. So now there is a tension because it's not this neutral infrastructure anymore, and it's part of a power play of who can get part of this infrastructure or not. And then if there should be alternative system, which obviously from a global perspective is not the best solution, but that's the point where we're at. And I think we are discussing at the moment, like how much can we manage everyone to get back together or not?
Why was Russia cut from SWIFT? Is it because SWIFT handle USD or these kind of things? Or is it like because SWIFT is like fundamentally like a US entity maybe, or like it's located somewhere, so it has to follow the laws of like some place?
No, Swift is fully a cooperative, so it belongs to a large amount of banks, a bit everywhere. But you get shares depending on how many amounts of transfers you make per year. And the biggest bank that does the biggest amount of international transfers are European banks, particularly Europeans and US banks. So it has been a vote of European banks of cut Russia off. So it's not a political decision; it's more a business decision. And it wasn't. I mean, there is some political dimension to it, of course, but it was private entities that chose that.
Yeah, I wouldn't be that adamant regarding the process of the exclusion of some Russian banks, because it was actually a list of Russian banks, because I believe that at that time it has been actually published by the European Commission. So I believe that it was like a top-down decision actually from the European authorities, because alors I fully agree with Xavier. It's a cooperative. Actually, the users in terms of volume are the largest users, are the largest shareholders. Of the entity, and basically this entity is established incorporated in Belgium. So under, I would say, the European, in this case, authority. So I don't remember exactly the process. Maybe the shareholder have been actually solicited on this, necessarily at least the board on this topic, but regarding the triggering event that led to the disconnection of a series, I would say, of a list of Russian banks following the invasion of Ukraine, I don't remember clearly, but I believe it was actually driven by the European Union.
That's interesting. So let's go back to Swift. I had a question on that, which is another one of my confusions. But is there more than Swift? Because sometimes when I hear these explanations on routing, people will use like Visa or like Mastercard or these kind of things. Like, are these things equivalent, or are these completely different things? But how am I supposed to think about that?
Swift is basically one of many. If you think about it, like Swift has a very large network effect, and definitely is deeply, I would say, deeply ingrained in the interbank, interinstitutional, I would say, transactions and settlements processes. Because once again, Swift in itself does not process transactions on its own balance sheet. They use actually, they facilitate the transfer from a balance sheet to another, but it's just a messaging system. And Visa and Mastercard, somehow it is the same. They established a network of participants, of infrastructures, and basically when you actually pay by card, all the cards transaction at the end of the day for all the banks in the world, they are actually settled to determine one position per bank per currency, and then Visa itself will instruct using Swift potentially a debit or a credit on an account that you will declare with a given correspondent bank. So basically, you have many transactions simplified into one Swift transaction at the end of the day for a single settlement, in a nutshell. So all these systems are complementary and interconnected.
So Swift is more like or just to repeat what you said, Swift is more like a simple system that you can use to build more complex systems Like it's more like a set of standard and maybe like something that's like DNS that you can use to like a database of like who has a connection with who, like what are the routes. But Visa and MasterCard and these kind of things are a settlement system, like according to what you're saying.
Clearing system. More like a clearing system, because the settlement takes place actually in the because the clearing is going to be the computation of the position of each and every actor. So you take actually, you know, this one owes to this one owes to this one owes to this one in this currency on this maturity. So when you clear, actually you simplify basically the interrelational debts. And at the end of the day, the settlement will take place in the balance sheet of a given correspondent bank declared by each and every participant. So you have like the clearing job and the settlement job, which is actually split into two different entities.
So I think I just understood the real difference between clearing and settlement. And correct me if I'm wrong, but you're saying that clearing is the act of figuring out who owns what.
Yes.
The settlement is the act of actually moving money.
Absolutely. Yes. It's a good definition.
Okay. And so in that sense, Visa, MasterCard are clearing houses because they don't move money. They just tell you at the end of the day, here are the aggregates after all of the transactions. Here's what you're supposed to move.
Exactly. Because you, for instance, you have an account with JP Morgan, for instance, and you pay, for instance, you go to Morocco on holidays and you pay RTGS Wafa. So basically, JP Morgan owes money to RTGS Wafa because RTGS Wafa actually paid the business owner because his card system was actually hosted by RTGS Wafa. And so all these transactions taking place based on the currency, based on the bank involved, will actually impact the end of cycle settlement.
And so one small question, and then Xavier, I'll go back to you. But like, do I use SWIFT when I do a transfer, like within France, for example, or is SWIFT really just international?
It depends. It depends on which because SWIFT is not only used for cross-border payments, but because they cannot rely only on cross-border payments for their business development, because it's still a company. At the end of the day, they try to make profit, or at least to develop their activities. They also provide, for instance, within the SEPA system, some messaging solutions for domestic payments and for domestic infrastructures. So you have actually a Swift offer for central banks when a central bank is actually willing to develop a new payment system and needs actually a messaging system as well. And so potentially, in France, I would say it is not necessarily likely, but I have a doubt now. But basically, yeah, you can for in some countries for domestic payments involve Swift as well. Yes. And depend on the currency, because for instance, I make a USD payment. Imagine I have a USD account with my bank in France, and I make a USD payment to Xavier if he has an account as well in USD in France. It will go still via the United States, right? Because you cannot have a settlement in USD in France because we don't have a USD settlement infrastructure. So it still go via SWIFT, via United States, via the Fed potentially, and come back to Xavier in France.
Interesting.
Yeah, so something that to me is still amazing in payments is how much different actors, layers stack on each other. Even like we simplified a little bit because Visa and Mastercard, they have at the minimum two different services. You were mentioning all the clearing and the network parts, which also can transmit some of the messages. But the upper part is the card you have, which is, there's also here a full set of standard on how the card communicates with the terminal, how the information is then sent initially, which is not already all the Swift instruction. It's just like how there is this first layer, like how you can also have rules on like if there is a problem, can you get the money back and so on. So there is a full commercial part to this. So this is more the payment side, and there is this network behind. Because here we are talking a lot about the infrastructure behind, but there is also a full question of network effects, and it's already a big progress that all the credit cards are compatible to each other, and you can use the same cards everywhere in Europe, in the US, and in other countries. So yes, there is different layers of that. One example of all of this is I've met recently one of the startups in France, a huge one, that does only B2B payments for large amounts. So payments between two big companies and for large amounts. And they are just specialized in that. Just because when you do a payment above a certain amount, it might fail more easily because there is a lot of checks. It could be risky for different reasons. The banks might put it on hold. So they just facilitate this. It's just a SaaS service that facilitates this kind of payments. And it's now a huge company because it's huge volume implied, but every category of payments, as Clement said before, has different rails actors to make them work.
Yeah, I don't know if you would count TransferWise or like Wise as like one of them. They're like sort of like trying to shrink the graph for people like me.
These actors are actually very interesting because I would actually summarize their activities are actually bridging some existing gap within actually difficult geographies. Because you have to consider that the financial system is not homogeneous. I mean, that's basically the topic I'm researching on in my PhD thesis. Basically, you don't have an homogeneity of the financial system. You have basically a north-south. I would say if we basically simplify the distinction, you have a north-south, I would say, a distinction. And basically, sometimes from the north to the south, you don't necessarily have the suitable infrastructures or the suitable offers or interbank actually bridges or highways to make payment circulate efficiently. From France to the US, it's easy. It's easy. To be honest, like you have basically an highway, a financial highway. But if you go, for instance, from France to I would say an emerging, let's say Cambodia, for instance. If you want to pay actually a payment in Cambodia, Cambodia is dollarized, so to some extent it facilitates the international interoperability. But if you want to pay in Cambodian riel, it might be challenging.
What would the path look like actually if I'm in Cambodia?
Yeah, for Cambodia, it would be quite straightforward because Cambodia is a dollarized economy, which is an exception, I would say, on the financial landscape, meaning that domestically, a very widely used currency involving as well the banks is the USD. I have an account in USD with my bank, and we use USD notes quite easily, so alongside the official currency. So basically, the commercial banks locally, they have correspondent bank in the US. So for instance, my bank in France would instruct its own bank in the US, transfer the money to the bank in the US of the Cambodian bank, and ultimately transferring. And there is no, not so much, I would say, financial frontier in Cambodia. The circulation of cash is actually not that regulated. But if you go to a neighboring country, Malaysia, for instance, so they're not as much dollarized than they use the Malaysian ringgit, and it's an extremely closed country from a financial frontier perspective. It is way more challenging, and some actors like TransferWise, Wise now actually, but not only. You have actually many actors, and of course this one is extremely visible because they gain so much popularity. But they will focus on these pain points and offer qualitative solutions basically to accommodate some kind of payments, mostly the retail payments or the SMEs payment, but they might not actually compete, I would say, from my outside perspective, but I would say they would not compete with large banks on large value payments typically.
Just to emphasize this, there is a tragic aspect to it because for some countries, they have really poor connection, even if no connection. So if you are a citizen from these countries, you cannot even get a freelance job from remotely because there is no way for you to be paid because there is absolutely no graph connected between your local banks and international banks. Or if there is a connection, the connection goes through multiple hopes, and in the end, you lose half of the money by fees and so on. So it's really tragic because some countries, the economies is slowed down, the opportunities for people there are really limited because of this lack of connection.
Oh, so maybe that's where crypto might have a very good use case, right?
But crypto are pros and cons on this aspect because there is a recent paper from the IMF, if I'm not mistaken, stating that crypto actually contributes to escape capital control. So then it actually raises the question if about like what do we think about capital control? How should we enforce them? I mean that's a full other discussion. But indeed, there is the risk behind financial technologies, financial innovation. Now it's crypto, but it could have been actually something else in the past, and it will be probably something else in the future. And this is very much in line with the instability aspect of innovation. But to I would say challenge for the best, but sometimes also for the worst, the existing regulatory framework and what it intends to do somehow. But from a very pragmatic and technical standpoint, yes, crypto to some extent can facilitate some movements that were willingly or unwillingly prevented.
Yeah, especially stablecoins. Like stablecoin is a global payment rail that's available to everyone with a form of stable value. So definitely there is, to me, a lot of benefit to this. But yes, indeed, there is a question of how it will interplay with all the rules, because most of the problem are these rules. Like there is many, for instance, one of the reasons there is no connection sometimes is because some banks, for instance, from a developed country might not want to interact with the country because the country is on some gray list because like the government has decided that this kind of this country is not putting enough efforts in avoiding money laundering and so on. So then, yes, with crypto you can do business with them, but do you want to? If it's just paying a freelancer to do your website, that's probably fine. But if you start to doing bigger businesses, like how much do you want to be interacting with people you're not sure at all what's happening and how much the money is going to be used by different kind of shady actors? That's something that is a question.
So it's almost like you'd want like a stable coin that's very easy to connect to, but that still can enforce a number of rules and can still enforce like some topology that we want to enforce, and in spite of being very easy to connect in.
Yeah, but it's really not neutral, this enforce some rules. Like we decide the rules, what are the rules that are acceptable? There is always a political dimension that doesn't make free sense. There is always a bit of laziness sometimes of administration or private actors that just cut a lot of actors just as soon as they are gray because they don't want to touch them and avoid any risks. So there is this layers of prudence that end up with cutting a lot of opportunities for many people in the world. So that's, yes, we could say that there should be good compromise, but I mean, I'm not sure the technology will change everything. It just maybe it makes the debate a bit clearer because before there was no rail at all, so you could not even ask this question. Now that there is a rail that's easy to use, okay, could we find some way to bake into these some of rules that are the one that make the most sense for all the participants in this system?
Okay, so maybe it's a good time for me to ask you the question. But what do you guys think about crypto and this new like world of like, yeah, like I don't want to say modern finance, but like this new technology, I guess, let's say, and like these stable coins, these ICOs, and also maybe I should mention the fact that you guys are often called Tradfi, traditional finance. So it's kind of a two-part question. What do you feel offended by that term of Tradfi, and what do you think of this new wave of crypto technologies?
So for me, I started. I think I dive deeper in all these topics because of crypto. So it's like I don't feel like I'm always in between the two words of TradeFi and more crypto. So yeah, I'm not seeing a big divide. And all my work has always been on how we can mind the gap, because I think some of the ideas of crypto are particularly valuable for the traditional financial system, or the standardization that happens, all the trust minimization, also all these technologies from zero knowledge proof, really well, and all these technologies that allow to guarantee that something happen as it happened at the technological level, because then you alleviate a lot of the problem that happen at the higher level, which is like, what do we agree on, and the business side of things. So I think there is so much things in crypto that are being onboarded in more traditional finance. What I have seen is a lot of cringe also, and I think everyone in crypto has seen it, like all the tentative of just adopting some of the crypto things without fully understanding them. That's what happened with some of the private blockchain that were just like running on in a closet, and then yeah, it's a blockchain, so it's better. No, it doesn't really bring anything. There's so many things that don't work.
At the very least, on that, what's nice is that people can experiment. Like the barrier to like experimentation seems to be more open. Like it's impossible for someone to open a bank today, right? Or to create a new derivative, but now anybody can do it. And so there's maybe like if you're more on the studying side of things, it's interesting because you can study these things more easily.
Yes, I fully agree that and what I've seen, and I work with different central banks that are working on projects, I can see that the maturity on understanding the technology is increasing every year and strongly. What's great is that also there is more convergence with what's happening in permissionless blockchain. Is slowly, I think there is a realization that we don't need to redo everything that happened in crypto the way that it should be done in Tradfi. It's more about, okay, we need to adapt. We need to adapt something that needs to be added some permission, as we discussed before, to some rules. But it's getting more fine tuned of what we adapt. For instance, the languages, even the software. There is this idea of like you cannot just recreate everything from scratch. As an anecdote, I remember working in a hackathon on Quorum, which was the JP Morgan spin-off of Get. So they were having their own clients modified, especially for
so Ethereum client.
Yeah, but they created an Ethereum client specially for banks, and slowly they dropped it, and now they adopt more standard ones because it's hard to compete with a full open source ecosystem that moves fast and beyond the side. Just to finish on this, and I let Clement having his view also is maybe from the crypto side, what I see is at the beginning there was a lot of defiance and a bit of also like snobism, like crypto people thinking that they were doing everything better because they had this new thing, and part of it was totally full. Like part was true, but part was just because they were missing all the complexity of what needs to happen from the retail question, like how you make sure that your grandma understands what happened and don't lose their money, to also all the link with all the different actors. Like once you are discussing with 180 countries, it's much more complex to make sure that everything works for everyone. So that explains a lot of things. So there was a lot of snobism, and even the rules and regulation, like not all rules and regulation are just paperwork to annoy everyone. There is a reason often they exist. There has been, actually most regulators act only when there is a crisis. So every law that we have is just a result of a prior crisis. So maybe it's not necessary to nowadays and could be adapted, but there is a reason, and no one creates a law just for the sake of creating a law.
That's funny. I heard the same in companies actually. Like people say every process that we have in a company is the result of is the echo of a previous accident that happened somewhere in the past.
Yeah, so I feel like now the tone is getting better and a little bit less defiance. And I like Tradfi. I think it works as a. What I don't like so much is sometimes the wording of like this legacy system and this new system, because crypto is already, to me, already starting to be legacy, as we discussed. Like there is already a lot of things.
So you don't like legacyfy, but we are all legacyfy. So I think we can agree on that.
Yeah, it's just a question of time before you legacy.
Right. Before you join the legacyfy club. So do you think there's also a part of snobism in the other way also? Like I have a lot of my friends, I guess because I'm French, like in France, it's a common path. A lot of my friends are work in banks, and they get kind of triggered when we start talking about crypto. And it's always hard for me to really make the case that there's a certain use or that it can be an interesting backbone for finance. And I'm actually very curious about what they're going to think about these podcasts. I'm going to send that to them after. But yeah, don't you think there was also like some sort of snobism from TradFi on these new technologies? Like, what is it trying to do? It's trying to replace us. Doesn't make sense.
I don't know. I mean, this is very much a tricky question because that's the kind of question you're recorded, and then in 5 years, someone is going to say, "Oh, you said that, by the way, at that time." So like, it's a
safe space. It's a safe space.
But well, so I'm going to be careful, but to go back maybe to the question first of what do we think of crypto and what do we think of the terminology of TradFi? I mean, as a researcher, I would say that yes, it's fascinating, right? Because things are moving and there's many new things to follow. And very like a year and a half ago already now, I discussed with a French researcher, if I'm not mistaken, it was Raphaël Porchero, and he actually went to Argentina to study like the development of a new local currency actually developed on a decentralized ledger. So I don't remember which one, but it was extremely interesting because he was actually from a social, I would say, standpoint, trying to see how communities are appropriating this new technology to create domestic local currencies in a country such as Argentina, and has a long actually legacy of currency troubles. But it was extremely interesting to see actually how beyond what we see in the main, I would say, media, even locally in other geographies, the topic is actually embraced and adapted for local needs, because it makes a lot of sense if you think about it. Like the way the technology is adopted to fulfill very concrete needs somewhere is what makes it interesting. And I would say, as a payment specialist, I would say the same. Like we cannot be blind. I mean, payment payment system today are not perfect. They are better than what they used to be, and they are still improving. And to that extent, to keep improving and to keep actually bringing the financial community, not only but also the customers and also like all the users, basically toward better payments. Because I mean, there's all the topic of seamlessness, transparency, less of friction, all the FSB, Financial Stability Board targets. To go in that direction, the new technologies underlying actually the crypto sphere are interesting, and you see slowly that they're trying to adapt it in a purist way, and sometimes in a diverted way. I mean, I think that's we can as well discuss about this, but that would probably be a mistake to stay fully closed and say no, this is not a reality. We are in full denial. I mean, that's but I think nobody is doing making this mistake now, I would say.
If you're starting from scratch, like if you're starting a currency from scratch because your country or your region doesn't really, like if you have the USD, of course you probably don't want to do that. But in a different situation, like it's just like all the frameworks and libraries and things that you need to start a currency are already there in cryptocurrency. It's all open source software, and it's pretty solid software. So there's no reason not to use that, even to start like a normal currency and make it like instant. And
that's all the question about like yes, like for instance in Cambodia they use the Soramitsu ledger actually to power their local payment system. So they have a Fedwire basically, and this a FedNow. See, I'm mixing up as well. A FedNow, and this FedNow is actually so the name is Bakong, and is powered by Soramitsu. So basically the banks.
what is Soramitsu?
Soramitsu, I will let Xavier detail on this. He knows better Soramitsu.
Yeah, it's a company that works on blockchain software, and they have created this open source version of a blockchain that's a bit more efficient, called Iroha. That's hosted also with by the Linux Foundation as part of the Hyperledger project. So it's this a blockchain tailored for this kind of usage that has been designed.
I know there's like Fabric, and there's a number of like such products. Is it not decentralized, or is it decentralized just not at the scale as some of these?
No, it's a private blockchain, and the only operator is the national bank, if I'm not mistaken.
Oh, so I guess what I meant is like they could very well run it on like 10 different servers that they have, but they decentralize it for themselves, right? Like to make sure that a compromise somewhere in their database, in their data center, doesn't compromise their system. So like decentralization is a spectrum, and I don't think this. I think it's fine for like an actor to like spin off their own blockchain for their own use case with their own, decentralization settings.
Yeah, to me, I see it as, but it's another debate about how much, because that's the problem of often looking from crypto perspective. Like the purely decentralized ethos is this vision of creating an open ecosystem where everyone can participate and so on. When you start controlling things, what do you retain from the system? And I'm not sure decentralization itself is really what you target for. What you target is having some sort of shared control and not making sure that there is some sense of you have guarantees that you will still have access to the system and you will not be cut out without some rules and so on. We go back to also having a rule of law, right? And that has been one of my irritation in crypto from the beginning, as I studied law before, is how much sometimes people reinvent and want to enforce technologically things that can be guaranteed by processes and laws. And it's not just a binary system. It's not because one person controls it that you cannot just create all the rules and make sure that it will be fair for everyone to participate. Yeah, I wanted to go back on the perception also. One important thing is you mentioned the private banks' visions and some defiance and so on. What I want to say is as said Clement, there has been a change of tone. So like definitely 10 years ago, it was rubbish. Even I remember people in computer science. I have a couple of friends that does computer science and were saying, yeah, blockchain is just a stupid like chain of hash and a proof of work mechanism. Like, why are you interested in this? It's just a stupid mechanism.
That used to be me.
Okay. So just to say that there has been a lot of skepticism from different angles for different reasons. The people I work the most with are the public sector actors. So the central banks, the international organization like IMF, BIS, World Bank, all these kind of people, they are interested in how they make payment function better and move forward. Contrarily to some actors that are private actors making money off how there is friction, that might be not interested in things going forward. Or the public sector, they might be misguided, they might sometimes be a bit too prudent, but what they want is the system to work better for most. Otherwise, they would have higher paid job in the private sector. And so all these actors, I think, have now passed the cap. I mean, not everyone, but there is a global consensus that has just shifted and moved from the tip to say, okay, we think that there is interesting things happening in crypto, and we should get inspiration and start looking at this more closely. And we go back to this conversation, and exactly the conversation we had about specifically how backend works is like what we retain, what kind of technology we use, what's really the innovation that's happening there. Is it just using this a new system, or there is specific things? That's where, to me, like for instance, trust minimization is one of the key new concepts that's still not easy to understand and grasp because it's really technological. You understand perfectly as an engineer, but as a business person, what means trust minimization it's a bit weird. So I think there is this tipping point where there is an interest. There has been enough reports saying, okay, we need to look at that more closely, and even look at permissionless blockchain, which is totally new. That's just 2 years ago it started. Even what's happening in permissionless blockchain, maybe there is something interesting there, and it's not about just recreating. It's also about using them as they are.
So what do you mean they started 2 years ago? Because when you say permissionless blockchain, I think of Bitcoin, which started more than 2 years ago.
No, I mean, just what started 2 years ago is the public sector's actors and the central banks and all their organization to start saying, okay, maybe it's not about just we leave public blockchain as they are and we create everything a bit better in our regulated environments, but maybe the public blockchain are part of the solution, like we discussed, like maybe stablecoins to move money over the world is a good solution in the end. Maybe Bitcoin makes a bit of sense, but I don't think they have much interest in the price of Bitcoin. What's interested is how it facilitates payments globally. And so that's what has changed, because until 2 years ago, the most you could have is we will have a big, large private blockchain that will get inspired by what's happening in public blockchain. What's new is to say, oh, maybe we could use them part of the solution.
And I actually so I think that's a good segue on the topic of like large private or like semi-open blockchain. So I know Xavier also you did some work there, but I used to work on a cryptocurrency or perhaps a cryptocurrency called Libra, and I'm wondering I have a lot of thought about that myself, of course, but I'm wondering what you guys think of these kind of initiatives that were supposed to sort of bridge the gap between not being too open and having like something that still brings these new technologies, but is more closed in the sense that it was regulation friendly and was supposed to have rules and was supposed to have a less it's not anybody that can run it. It was like a set of known entities and legalized entities and these kind of things?
Yeah, that's a very interesting question regarding Libra. I mean, the risk behind Libra was somehow to create like from an accounting perspective, once again, a monster. I'm going to explain why. Because like now, technically, if you think about payments, and is it a good thing, is it a bad thing? That's another discussion, and we have to actually go back to at least Bretton Woods to talk about it. But there is no central bank of central banks. Every central bank is actually, I mean, people say the Bank for
I thought
International
it was the
Settlement, but it is
BIS.
not. No, like
It's not a central bank.
no, it's not a central bank. I mean, they have like asset and liabilities in many currencies, but it's a very small balance sheet at the end of the day and a small entity. So there is no proper central bank of central banks in the sense that there is no.
Are you saying that not that many people use the BIS? Is that what you're saying, or?
I mean, they use the BIS, and I'm not a specialist of the service offered by the BIS, but I believe that they offer some account for central banks, and at some point they were running actually a payment system in Europe after the Second World War to actually help the assist the reconstructions, the intra-European trade without using actually USD liquidity. You were using basically it was an ACH basically. Anyway, but let's say that now I would say the role of the BIS is quite marginal to that extent. I mean, there is the BIS Innovation Hub, and they are very innovative or thinking forward from a payment system perspective, but they are not actually the proper central bank of a central bank, and that's why basically everybody is using the USD because that became the global currency in addition to the domestic currency of the US. And what Libra was actually proposing to do was basically through their balance sheet to have to issue a stable coin, a Libra coin, being a liability. And on the asset side, it was supposed to be collateralized by a basket of currencies. And typically on the asset side, you would have had Euro, USD, Chinese Yuan, GBP, CAD, CHF, and so on and so on. So basically, you had this kind of super bank having actually assets everywhere and liabilities owned by everybody, actually being there and actually recatching the central position of what is supposed to be the central position of central banks within their own domestic space, with the huge challenge it actually raises in terms of regulation, in terms of supervision, in terms of stabilization, because if you have actually at some point this giga entity failing or struggling from a liquidity standpoint, for instance, not only one central bank has to intervene, but potentially a consortium, and it's very difficult actually to coordinate. I mean, the more you are, the more difficult it is. It's not just applicable to central banks. It's an organizational challenge, but that was actually the risk under Libra, and it was creating from above like this, from below actually this raising entity, privately owned, actually monetizing some kind of very complex asset.
To me, Libra was the right idea, but probably at the wrong timing and not with the right backing. It was the time where Facebook was under a lot of heat, and was not the right time for becoming the central actor of payment when it was already creating tension by its role on information and so on. Probably it would be different now because somehow there are other platforms that have taken more of this kind of heat. But also the timing was too early. And as we discussed, there is a time for also the culture of some of the actors, regulators, and so on to adopt and understand this vision. And it was done with this brash Silicon Valley attitude that works for some sectors, but from others that are super governmental, there is a reason. It's more controlled, it's more cautious because that has a lot of implication and consequences. So maybe it's not ideal, but I'm not sure the opposite is better. And so yes, it came a bit early, but that's also the precursor. And every discussion we have now, and why I'm a bit more positive, is thanks partly to what happened with Libra. It was opening the way for everything else to happen, but it was definitely too early and opening too many things at once.
So maybe if today it would have been done today, things would have been different potentially.
But also done differently. Like for instance, 100 actors, only actors from the Silicon Valley, not only, but like mostly That's not a great idea. I'm sure even if one big actor was trying to do it now, it would start with creating more partnership with banks or these kind of actors. Of course, they are more slow to be on board, but you need this kind of backing. And you see it now, like every new projects of this kind is a more complex partnership. Just the stablecoins. The stablecoins are just using the public blockchain as it is. So because Libra was too many things at once, it was an asset, but it was a full new infrastructure at the same time. No, you can use just the public blockchain. They work. That's fine. And create these stablecoins. And the stablecoins are big partnerships because you need to partner to have the assets on one side. So you need banks, you need different assets to protect them. But then you need also a partnership to make them useful. So that's why you have partnership with Visa and Mastercard to make it easy to spend your stablecoins now. You have these Gnosis Pay cards and others. So it's you can see how it takes a village of things to work better, and also that allows everyone to position a bit more in a specialized manner on where they are the strongest. Like people in stablecoin are failing in reinventing a way for you to transact easily. Like I don't pay from crypto wallet to crypto wallet. That doesn't happen, but there is already credit cards, so you partner with them, and they are better at creating this smooth experience, at least in Europe, depending on the continent. But you see how different it's how an economy should work, right? Everyone does what they do best, and they do it together.
Yeah, but somehow, if you think about it, that's going to be maybe it's a polemical, I would say, statement, but a bank in itself is somehow of a stable coin. If you think about it, because actually, when you have actually a stable coin, you have a liability of a issuing entity. When you have actually a bank account on your mobile phone, you have as well actually a liability of an entity, and there is behind this entity the promise that your liability worth $1, for instance, and basically that the asset on the asset side will enable the liquidation of this liability anytime you need it. But the thing with a stable coin, which is more like a tracker in this case, because they cannot actually create new money, they have to collect money to reflect it. But so it's more of a tracker if you think about it. But the promise is the same with actually a lack of or not already yet adjusted regulation regarding the stablecoin. It's ongoing, but yet to come regarding the guarantees offered to the liability holders, or at least the level of risk that they are taking. Because some people, they take actually a stablecoin and they buy a stablecoin and they believe that they have actually a very liquid, but based on the quality of the asset, you will have or not a good or potentially risky stablecoin, depending on what actually the stablecoin issuer put on the asset side. Is it stock? Is it bonds? Is it cash? I don't know.
I don't fully agree with the analogy. So part of the analogy is on the backing, and we can discuss this. It's a different model because you have different type of risk. It's a lot of normally liquid assets on stablecoins, at least the ones that are regulated under MiCA in Europe.
By the way, maybe I should mention, I think Libra moved from that because it received quite the heat, and I think the plan was to actually just have some like a reserve of cash after. And
yeah, on the second version, but I think the big difference with stablecoins compared to a bank is it starts from the payment system. It's like the bank start by having a relationship with people, and then they try to sell them a lot of services. The stablecoins start more like I'm creating this asset that's super easy to transfer, and then we are creating a different ecosystem around it. I think that changed the kind of actors and how you make money and a lot of things around it.
in the case of Libra, I think what was scary for people is that, like, if it had launched, it would have been like available on day one to like any Messenger user or WhatsApp user or Instagram user. And I think that was the direct relation, right? Like you could have transferred money anywhere in the world, or at least that was the idea. I don't know if they could have done that just using WhatsApp.
But on this, I remember I dived into it and wrote a short report. What amazed me is to list all the prior failure of Facebook of creating such a payment system. So there was this assumption and worry that because it was Facebook, immediately everyone would have access to it and immediately it would be a banger. But Facebook has a history of having tried to add payments to WhatsApp, to different versions of Messenger, different kind of, and it always failed. So Maybe it was regulation, maybe it was adoption.
That was kind of my theory also. So they failed payment in like Brazil, in India, in a number of places. And my theory was that, I was just an employee at the time, so I don't have access to, I was not in the room where it happens. But I always thought that they took the crypto route because of all these failures and like the way they had to deal with like governments and regulations. They were like, all right, if we do a cryptocurrency, people are just going to be able to use it. Like it's going to be very hard to like stop it. They might stop it on WhatsApp, but people will find ways to use it. And maybe that was this sort of a loophole that they were hoping to find. But again, I don't know. As an ex-employee, I have no idea.
That seems to have been part of the reasoning and part of why it had some trouble also, because that really brushed people in the wrong way. But just to say on the failure of other payments is like, so part was of, I don't know why it failed, all these prior initiatives, but part was probably a regulation, how heavy it was and so on. But also we go back to what Clement said at the beginning, is like payments habits are really a cultural thing. It's not commercial, it's cultural. It's like you pay in a certain way because you that's how you behave as a culture. Like you give certain type of gift. I remember my grandparents, they would never make a wire transfer to me. My grandparents, when I would see them, sometimes they would give me a banknote, and they were proud of giving that banknote. They had gone to the bank to get fresh banknote and give them to me. There is this sense. It's I think every culture has a very different way of how to behave. Culture can evolve, of course, and they have evolved in different continents in different ways. But we can see how diversified it is and how it needs to click between what offers the private companies and how people want to behave. And it's something you do every day. It's something really. It's not a technology. It's in the end, it's an act, and it's one of the most meaningful social act you do. Like you're transferring property and the right to get something later from someone else. It's sort of it's the full. The social fabric is bound by this relationship of you paying someone and pay someone and pay someone. That's what makes a society. So you cannot just come and hope because you have already some sort of relationship with everyone that they will just jump on your system because you think it works well.
That's what I like with Libra also. Like I felt like Facebook Meta was like well positioned because they're very good at connecting people and finding ways to make people interact. And I remember at the time, like we were doing all these studies, like employees could like go in different countries and take part in these studies, like in the Philippines and so on, and interview people and see how people were using money. And remittances was like such a big thing that we wanted to focus on that in the beginning. So I think there was a lot of effort to do exactly that. Maybe like I know we wanted to talk about border payments and like maybe regulations and so on. Like Libra, I remember when I was at Libra also, like one of the big thing we were talking about internally was the travel rule. And the travel rule, if I understand correctly, was this rule that if you send money to someone else, I don't know if it's like in a different country or like just a USD or something like that. And if it's more than like 1,000 or 10,000, then you have to do a KYC of the recipient and the sender, and this has to be sent somewhere. Like I never fully understood exactly what this travel rule was, but it always sounded like a big thing, and we sort of had to like retrofit that in the protocol. And so we were talking about that. We're talking about the OFAC, which I think is a list of banned entities or like people, and there were all these sort of regulations, and it was we were sort of at the point where we had to decide like how do we, if we want to be a regulation friendly, like take part in the current system, and if we want people to be happy with us, like regulators and so on, how do we integrate with all of these things? So yeah, I was wondering what you guys thought about that.
Yes, but actually to come back, because you said actually something interesting regarding the prior experiences, I would say, before the failure of Libra in Brazil and in India. And basically Brazil and India are maybe two of the most regulated countries in terms of cross-border financial flow. Actually, it's an historical legacy, and it's no surprise actually that it was actually a challenge for Facebook to crack these two countries. But and you said that the crypto alternative was in this case maybe a way to tackle this challenge and kind of go override it. And at the same time, as we said earlier, that organization, they learn from their mistakes, right? That's the idea. Like you make a mistake, you make a process not to repeat this mistake again. And if you think very basically about regulation, regulation is this. We made a mistake at some point, some bank crashed, we don't want this to happen again, we set a new regulation. A new bank is going to crash because all the time someone is going to try to be smarter than the regulation, eventually will crash, and then you have a new regulation, and so on and so on and so on. And so basically by offering a new solution tackling fully the existing regulation, because there was no regulation, as you said, applicable to crypto at that time, it was opening wide the Pandora box of all the previous crises that many countries faced, and exposing again the financial sphere to it. So as Xavier said, it was not politically, it was extremely risky. I mean, it was a bold, I would say, initiative that actually raised concern, because like it was opening back some old demon, I would say, in terms of financial stability potentially. But then regarding the travel rule is just one piece of this huge regulatory edifice, because regulation is extremely complex, and it can entail the financial stability, but of course as well the financial security. And behind actually, if we don't, without going as far as the sanction, because sanction is always, of course, a difficult topic to address because there's geopolitics behind it. But behind the travel rule and the financial security, you have more, I would say, like straightforward points, such as the anti-money laundering, the tax evasion, the counter like the financing, sorry, of terrorism. So basically, the idea is to make sure that
So AML and CTF.
Exactly, anti-money, exactly. CFT. And so basically you have this idea that your money should be, and fraud also, because without going as far as illicit use of money for the others, think about the illicit use of money for yourself. And when you actually believe that your payment is actually payment to a company, but you send it to a scammer instead, behind actually the travel rule and the identification of payments, or at least of the purpose of payment, you have this idea as well of securing the transaction for the initiator as well as for the system, holistically speaking, I would say.
Yeah, because that's something that's important. It's like from the crypto perspective, I see this blurry thing of there is this weight of regulation coming. What's to be understood is like financial regulation, they have very different packages that come from different reasons, for different motivations, and are even like enforced and updated by different entities that are very distinct. So yes, Clement made quite a good list of what are the high-level objectives, and then depending on the objective, there are different actors doing it. There are also other policy objectives that are tied to it. These are the ones that are the one that Clement listed are the ones that are the most critical and central to making sure that the financial system works. Fraud is a huge topic. Like every year in France, there is a report about all the fraud on payments that happened, and it's a few percentage points of all the payments are fraud of different kinds. And by fraud, we mean like nothing fancy, just someone that just got money that they shouldn't have because they managed to trick someone else. So it's very not so easy to do. And we see how in crypto it's even at the moment harder to do because you don't have that levels of redundancies, controls that facilitates that avoid some of these.
Right, but on the other hand, you also have something interesting with these systems. At least the transparent one is that they add more transparency to anyone can look and analyze the graph of transactions and maybe capture corruption or see these kind of things more easily than in the current system.
That's the topic that interests me the most in the recent years. Is like how much we need. So like you cannot dismiss the objectives of the regulation, and I feel like crypto at the beginning was just we just make it between consenting adults and it's fine, and we don't need to care about everything else. I think that works for a small group of people, but as soon as we want to be broader, that doesn't work. So the objective cannot be removed because they make sense, and everyone, I think, agrees on them. And at the next problem there will be, they will come back again for a reason. But for how they are implemented, there is room for debate. For instance, that's the debate around the crypto regulation, MiCA, that we have in Europe. Is like a lot of the rules require you to register, like if you are a financial entity, so that requires you to have money, hire lawyers, create a file, send a lot of proof that you do everything right, and so on. And I agree with you, and that transparency is just one side of it. Like also you have the fact that transaction cannot get stuck in the middle, so that doesn't happen. There's different aspects to crypto that should probably force to rethink how things are done, but it's not so easy because it's creating a new models and it's easier. And here we go back to what I mentioned before, like some regulators are just lazy. They just apply the same rules in the same way they have done just because it's less work. And everyone wants in their Friday evening to be able to go back to their family. So they don't do too much.
I don't know if it's, I'm going to just bounce on that point. I don't know if it's laziness or if it's like a risk aversion. Because if we think about fraud, if we just take an example of fraud, a random example of fraud, I would say starts from like a space that you will give actually to imagination. And that's, that can be sometimes very tricky. Like in Brazil, Central Bank of Brazil, when they launched their system PIX, a couple of years ago now, which is an instant payment system like FedNow. They enable every actually Brazilian to do instant payment anytime from a phone, probably including as well a QR code payment. And then they realized that when the after the night, like when it was like actually 22 p.m. or 23 p.m., the level of knife attack increased significantly, because actually the robber they adjusted actually their robbing attack by actually targeting people with PIX to actually transfer them the money instantaneously, and then they were actually making the payment bounce several times or on a fake account or whatever, and so like the central bank had to adjust. So behind every change, I mean, as a central bank, you have to be conservative.
How did they adjust, by the way? How do you fix that?
I think they reduced, we would have to check with them, but I think they reduced the amount that you can transfer at night significantly. So it reduces actually because you still have a risk to get caught because it's still a payment system, so you can see the name, whatever. So I think that there is this risk. But yes, if I'm not mistaken, after a certain time, like they reduce the maximum amount that you can pay for it to be pocket money, basically. And but yes, and so behind any change from a payment system perspective or from a financial regulation perspective, you open the way to some risk. And as a central bank, your first objective might not be always to promote financial innovation, or at least not to promote it too fast, because at the same time you have to ensure financial stability and money as a public good. And definitely you have to balance the benefits. It takes time. So, and you want also, because you are not the only central bank in the room, you want to see how the others are doing. So there is like of course a benchmark. And that's very interesting with the CBDC tracker, for instance. You see that when some central bank started to work on CBDC, quickly all the others, they followed, because it became kind of a central banking trend. So there's this idea also behind. It's quite complex.
No, but that's a part of where my frustration is. Something that I'm really looking and seeing often is how big institutions acquire knowledge. And when you're a big, large institution, it's not so easy because you can have one employee that just understand how crypto works, for instance, and like goes to different events and so on, understand. You can have them write a report, but not everyone will read it. And then how this report is translated in creating new policies and so on. What I see is how much it's not so much that it takes time, that I'm fine with it. And you need to have many people on board and agreeing to move to the next step. And so one concrete example to say what it means to adapt anti-money laundering laws to crypto in particular. Do we need to apply the same kind of requirement exactly, or can we make differently, because you know that there is some transparency, so maybe you could do it differently? And a simple question as that, to me, what's missing is processes that go in that direction well. It's all about sort of rough consensus, as we say in crypto, inside. And I think there could be better ways of saying, okay, there is a new topic, we have this process, we onboard new comments and so on. That's what you see with requests for comments and so on. But I think it takes usually a couple of iterations before it really is fully adopted by an organization. And I'm convinced that it could be better. But
okay, so Clement, you mentioned CBDCs, which was the next topic I wanted to talk about. So I'm really curious about what you guys think. Do you think something like these stable coins or like something like Libra is the next iteration and is still going to happen? Or do you guys think that CBDCs is actually the next the next logical step? And this is what CBDCs, by the way, are central bank digital currencies, which to me are cryptocurrencies that are run by central banks. That's probably the easiest way to put it. In the details, maybe not. It's more. There's more to discuss. But what do you guys think about that?
So just one thing first on CBDC. To be clear, there are three different components when we talk about a central bank digital currency. There is potentially an infrastructure. So think about creating a private blockchain to make it work, or any other thing. There is a payment scheme. So it's like all the rules we discussed about how you make sure that the information between your payment app goes to the merchant and then is relayed to whatever system is behind it. And there is the asset itself, because the CBDC, it's supposed to be sort of a token that represents central bank money.
Your second point is only if the CBDC targets retail, but do all CBDCs target retail?
For wholesale, it's not so important, yes. But already that shows you the landscape of everything that could be done with a CBDC. Because if we just talk about an asset or an infrastructure, it could be just something that's behind the scenes, just one of the systems that we discussed at the beginning of among RTGS, FPS, and you have another one that would be the CBDC system in a sense. It could have some properties that are interesting, but it won't revolutionize everything, how it works. There are two ways I think it's a bit more changing things. One is, indeed, if it becomes a retail payment system, so in a wallet, every day you use it and that's a new way of paying, because it disrupts a bit how payment works, the competition between the actors. So here there's a lot of commercial implication, political implication, and so on. And the part I'm the most interested is if it's a bit more ambitious on the wholesale level, so in the way of facilitating connection between the banks. And in particular, if on the same infrastructure, you can have the central bank money and other tokenized assets, so like shares of companies, bonds, and so on. And to me, here, that becomes mind-blowing, because once you have different assets that live in the same system, which is not the case, because today we have only talked about payment and we stay there, but it's a lot of other mess of any other type of asset on how they move. And so if you have one unified system where everything works together, that changes a lot opens a lot of opportunities. So that's two work streams that are very different when we talk about CBDC that are currently in the works.
Yeah, I'm going to be, I would say, on the same distinction, right? Like on the side of the inter-institutional, I would say, use of a CBDC, or what they call usually a wholesale CBDC, that makes a lot of sense, because as part as what we said a bit earlier, it's like integrating like the new technology to enhance actually the existing processes, or by reducing the risk, or by increasing the scalability, or by enabling to integrate new actors directly, because now they cannot be integrated directly because they do not respect the risk protocol. But if you manage to decorrelate the risk from the asset, or the risk from the balance sheet hosting the asset, you might actually have an interesting perspective as well to have like direct participants. So all these as Xavier said, to open the way to tokenization and to programmability. Typically, if you have PVP, DVP automatized and actually pre-recorded in the systems, it can be enhanced a lot the operational processes of all these actors and the fiability on the one end. Then there is the other end, and this is more to be discussed regarding the retail CBDC. From a user perspective, and this is not from me, and this is from actually a previous podcast I listened to a couple of years ago now, someone named Manmohan Singh. So I think he was working for the IMF or the World Bank at some point, and he was saying something very interesting. He was saying, why would I use a CBDC if, for instance, I have a deposit account which has actually credit interest on my bank, while actually when I pay with my card, I have an insurance. When I pay with my card, I have actually reward points. All these aspects behind actually the customer experience have to be taken into consideration when you choose actually an instrument. So the idea behind, so this is about the active choice of the user, but you can actually take another lens. And I visited Finland a year or 2 years ago now for a conference, and I discussed with people from the central bank of Finland, and they were saying, and we were discussing at the time. It was the beginning of the digital euro, and we were discussing about this, and they were saying, "Have you been to a shop in Finland?" I said, "Yeah, sure." He said, "Or did you see any ATM in the streets in Finland?" I said, "No." He said, "Because everybody is using the card here, and the cards are what? Are Visa and Mastercard." And he said at any time, and he said even that the banknote that we use sometimes in Finland, the euro banknote, they are not even printed in Finland anymore. So there is virtually no monetary sovereignty in Finland. They do not have actually any grip over the infrastructure they use every day, and they do not have even like the paper money printed domestically in case there is a disruption. So he said for us, somehow this idea might not be a bad idea. So it was early, and it was the early stage, because if there is the possibility for them to have some kind of pieces of this newly developed infrastructure, it might be as well a way to regain or to consolidate monetary sovereignty, in way have a mean in case of problem to actually maintain the circulation of money within their territory. And there's a strong dimension of basic sovereignty at the end of the day, because without money, I mean, as we said, disruption of payment system is inconceivable in our modern economies, and it's I mean, we see the crack of window. The Windows, like the last week when it's actually stopped all the air companies and create a mess. Imagine now a payment system, Fedwire, for instance, going down. You would have this times
the CrowdStrike bug.
Yeah, the CrowdStrike bug. Yeah.
So it's interesting to see. So you think it's an interesting, maybe it has some interesting use case, but it's not going to change. It's just one more system that countries can have. Do you guys know about what China is doing actually? Because China is they're already digital, right? Everybody uses WeChat to pay, and I know they were pretty big on the CBDC front, but I'm not sure, like what, or maybe more generally, like what are who is really experimenting with that? What are the big CBDCs like today? I just know the Chinese one, but
so maybe I will let Clement talk about the Chinese one that he has studied, but in details, but on the broader landscape. So just to tie up the prior conversation, it's the same as we had about Libra. It's about a question of habits, of what people want, and even the government doesn't have the power to enforce the system easily if it doesn't fit habits and so on. And it's super hard to design something that's useful and works well and so on. There are some examples already of not CBDC, but like of apps that are provided by the government in some Nordic countries, for instance, to facilitate payments. I've seen one where you receive your bills from like your different utilities, and you can just pay with one click. So it's kind of software email address and bank accounts in one thing where you receive all of this. So it makes it super easy for people. So I mean, there is a lot of ways government can really facilitate the life of everyone and doing digital things. That's something I'm really not comfortable in the crypto sphere and how they perceive sometimes all of this, because there is a libertarian version where we say the government has nothing to do and we are sovereign individuals and so on. That's fine. That's a political view, but it's not the one that most people want. At least it's not the predominant one in Europe. We live in a world where the state participates in a lot of your activities. And to me, it's on the contrary a shame how much governments have not stepped enough in the digital sphere and don't provide just a basic thing, a digital identity. It's not normal that it just took so many years that we start to have some good identity scheme that allows you to prove that you are really who you are and do different actions online.
Yeah, what you're saying just reminds me of like programming languages and how some programming languages have like very good standard libraries. And so it's very easy to build something or to like use somebody else's frameworks because they use the same libraries, because the standard library is pretty big, what they call battery included. And some programming languages are like, we're not going to have a standard library. People are going to have to figure it out themselves. And so they're not stepping in, I guess. And then everybody's trying. Basically, there's no standard because of that. And people are doing different things and interop is harder. I don't know if that.
I like how you make a very different connection, but I think it makes totally sense. It's a question of modularity and like how much we need to create in common some services, how much it should be different. It's also a question of like what can do well a government also. Like it's difficult to design some a system that everyone use every day. So that's why I think the major consensus is it's good to leave a lot of private actors try to do the right thing because it's difficult for the government to do something great for everyone. But as you say, is like something can be mutualized and done well and facilitate the life of everyone. So where the line is a good question. So now back to what are the big CBDC projects. There has been a few CBDC that have been launched already in some developing countries. There has been one in Jamaica, in Caribbean countries, so different small ones.
Interesting. And they're running today. They're running,
but most have not been a huge success. But it's just a question of project management, of the quality of the software, of the promotion, of how it fitted habits. And we go back to what you said, like how much was studied the local habits. I know an anthropologist that is working in Jamaica on how it's adopted, how people use it. And also she's looking at how much the companies are taking part of it, because you have some private companies that are part of the scheme and what role they take, because it's supposed to be from the government, but you can have some intermediaries that just become major actors, and that has also its series of problems. So there's these small ones we can discuss in details, but that's one thing. There is a couple of big projects. I think Europe has quite fairly advanced idea of creating this retail CBDC and a wholesale one also, but just talking about the retail. But to me, it's a bit curious the way it's approaching this, because there has been a few years of study recently with reports saying how it should be designed. For instance, it should have an online mode where you can pay like a PayPal account type. And it should have also an offline mode. So that's a bit more interesting, where you should be able to like tap two phones, for instance, and have a payment even if you don't have an internet connection. So that's a great idea. But how it can be done securely in practice is not so obvious. You might use the trusted enclave of the phone, but how you guarantee that no money is created, it's something that you want to make sure, because otherwise it becomes a problem. So that's one of the big projects. But why I say it's curious is because there is this kind of technical requirements saying how it's being done. Everything is getting prepared. There is a law that has been proposed to the parliament, but at the same time, no one has validated it yet. So we are in a democratic region, so it needs to be approved by the European Parliament and so on. And at the moment, most citizens are not even aware of it. The parliament has no really interest in this as a priority. So it's kind of a political project without a politician leading it. And that makes this weird thing, right? You don't have a political figure that has run a campaign and going brashly saying, I'm going to solve all these problems by having this CBDC that's going to work this way. You have a lot of people that have made a really good work at thinking all the problems and how it could work. And then you have this project that makes sense. But yeah, and now you have also
not enough inertia.
A lot of inertia, but also like a lot of disinterest also, like banks don't see the benefit because actually it could cut some of the profit they make from every card payments. Because when you pay with a credit card, part of the payments is paid by the merchants to the credit card companies, but also to the bank that issued the credit card. So everyone is getting a bit of money in the system, and they're not so interested in creating a new one unless we created the right compensation scheme. But if you compensate, you want to make sure it's not too much, not competing too much. So it's really a complex undertaking, huge, with no one that's really driving this, right? So that's a bit the way it works. So now maybe Clement on China, which has been the one that has probably attracted a lot of the attention and has sparkled the other one partly because it seemed to have gone forward fast.
Now, China went fast, but then I'm going to be like, I'm not going to develop that much on the case of China because I stopped actually following like a year ago. So I might actually be fully outdated on this to focus actually on Cambodia, where I actually moved. But yes, I agree with Xavier. Now CBDCs are actually becoming a reality. I mean, it's the case in India, where they're actually testing now the digital rupee. In Nigeria, it has been quite an interesting case and an instructing case as well, because in Nigeria there is not I mean the confidence in the naira is not I mean perfect, and probably one try behind like the central bank was to kind of consolidate this trust via a new CBDC. Banks, it became a mandatory requirements for banks to accommodate this new CBDC. The national bank, it's not the national bank, the central bank of Nigeria, they actually tried to cap the amount of cash that one could actually withdraw. So as a way to incentivize people to move to CBDC, they had to go back. They had to cancel, if I'm not mistaken, this rule. But yes, you had like it has been actually launched domestically, and yes, in the ECCB, so in the Caribbean, in Jamaica, and in the Bahamas. But yes, but there is one point also regarding Europe, which is quite interesting as well. As Xavier said, I mean, there is a big chunk of the transaction which goes into fees when you pay via Visa, Mastercard. So you pay actually at least more direct fees than using cash as a merchant. Then you know that you have indirect costs related to cash, because cash, you need actually the equipment, you need actually to secure it, you need actually to bring it to the bank. I mean, it's a non-interest bearing actually instrument. So now if you have a card payment but you cash your cash only like in 20 days, you will not get the interest. So okay, cash is not free either, but there is this gap. And in Europe, if I'm not mistaken, business, or at least in France, business, they cannot distinguish the price based on the payment instrument that you use. It's not the case in every country. In some countries, you pay more when you pay by card, 3% more, 4% more. In India, typically. And in this case, if you launch a new payment instrument, it cannot be cost driven from a merchant perspective. It has to be user driven. And to that extent, let's see how it's going to play for the case of the digital euro. But a merchant will not be able to say it's cheaper if you use the digital euro.
Like in France, you'll see stuff like you cannot pay by card for less than €5, something like that.
You have a minimum, yeah.
Because they take in the cost, right? Whereas like in the US, you'll see, okay, you can pay by card, but then the price is higher if you pay by card. Like you'll pay 2% more.
Yeah, and if you have an international card, it's going to be 5%. I mean, there's this idea of the price is going to be impacted by the payment scheme that you're going to use, and this is quite interesting.
Interesting. Actually, I had like one question that I wanted to ask in the beginning, and I never got a chance. But I think it's still interesting to mention it. But my question was, so if you use a CBDC or if you use like a cryptocurrency, there's this idea of total supply, where you can really track how much money exists, unless it's a private coin or privacy coin, where like you don't really know, people are making payments and everything's hidden. But in a transparent blockchain, you can see all the payments, you can see the total supply. Okay? There's never, in Bitcoin, for example, there's never going to be more than 21 million Bitcoin. I don't know how many Bitcoins have been mined today. But for the USD, or for like a real currency, like a fiat currency, it sounds like it's very hard to figure out what's the total supply, because every bank is basically its own cryptocurrency and has its own like database and is creating money and burning money every day, depending on what they're doing. And so my question is, how does a government, or like the person that's really in charge of a currency, maybe I'm very US focused, but we can talk about the Europe, it doesn't matter. But how do they make sure that the total supply is not doesn't change, and that banks don't start creating money out of thin air and or start burning money.
Yeah, maybe there is two parts to your question. One is how no money is created in an illegal manner, which you don't want. Someone just printing money in their garage and create with a machine, like as you might have happen and still happens a little bit. People printing banknotes, and the same like for banks. You don't want a bank to just use their pen and create money out of nowhere without like registering it, because creating a loan, as we said, is creating money out of thin air, but it's just creating with some rules, with transparency, and with normally some ratio of assets in front to make sure that they will be able to pay the money. So that's the rules part. So that's the one where you want to be super strict, and it's some of the laws that have the harshest penalties. Like if you counterfeit money, if you fail on of this, there is harsh penal consequences everywhere in the world, because you really don't want that. History, one of the first banknotes were, in China, and Marco Polo was discovering this and found it fantastic how they were using this paper and creating these banknotes and selling them. And the penalty you would have for counterfeiting was death, obviously, in the harshest manner possible, because that was really important, and it still is. So that's for sure. But then the other question, which is how you know what's the amount totally in the economy, I think that's something you have to be comfortable that it's not a precise number. No one knows exactly how many, and no one cares. What matters, we go back to my analogy of the blood, is that there is enough blood for the body to function. No one cares if you have 5 liters, 20 liters, 50 liters, as long as it's the right amount, and make sure that you have oxygen coming to your fingertips every minute, that works.
It's not just malicious counterfeiting, right? Like I have this friend in France that works for a bank, and he was telling me about this story where like they were getting these XML files like twice a day or something like that were telling them like how to settle with another bank. And one day they got some error happened, or I don't know what happened, but they only got one file. And so basically what happened is that they repeated the payment twice on that one file. And so I don't know how much time it took them to like basically fix that, because they had to do a bunch of manual transfer, because they had credited their clients twice and debited their clients twice. And then like if people started doing other payments, then it can sort of become problematic. But that's what I'm wondering, because everything's so ad hoc, so customized in this banking system. We don't have this like one central database, like up in the air, where you can really see that like everything's going well. Like everything seems to be, if a bank starts creating money like by mistake, like how do we catch that? Or
no, I mean, regarding like the question of the monetary mass, it's a certain figure. I mean, you have several monetary aggregates. You have the central bank money, which is basically M0, and then you have like the more you go, you have M1, M2, etc. And basically you include then the short-term deposit and the longer-term deposit. Okay. Already regarding the central bank money, you do not know for sure. I mean, basically the digital part based on the ledger of the central bank. You know as much how many actually notes you issued because you issued them at some point and they have been recorded. You know how much potentially came back, but you're never sure 100% of how much is actually circulating, because some might be circulating, some might be actually stored, but some might be actually destroyed simply. And you will not get a notification when you burn actually a 5 USD note. It's still recorded as a cash in circulation in your balance sheet. So that's the first thing. And regarding the commercial banks, yes, as soon as you are actually in a two tiers commercial, two-tier banking system, there is the operational risk, and the risk that the bank go through what you gave as an example. In this case, it's unfortunate, but you have a regulatory actually background, supposedly I would say applicable in this case. You have penalties when the bank actually declares such an incident. They actually have to declare it to some extent to their authority, regulating authority. So you have actually a lot of ring fencing to first preventing it to happen, and second to to manage or handle a situation when it actually happens. And this happened to Citibank as well. I think a couple of years ago as well, they sent like a huge payment twice, and they went through like a legal battle with the beneficiary because they didn't want to give the money back. I mean, there's this insane story, and yeah, this is the nightmare of every banker, right? Like you don't want actually to send several million twice especially if it's in another jurisdiction, because maybe then you have actually capital control.
Especially if it's on a Friday night.
Especially if it's on a Friday night, because you lose the interest over the weekend.
I mean, weekend.
Yeah. So it's very tricky, but to the point of Xavier, because I like very much the idea of fake money. You know, what is fake money, what is not fake money, and typically there is this example of this is an anecdote again, but in Somalia, if I'm not mistaken, or Somaliland, they were actually at some point facing like a huge inflow of fake money, and the national bank, the central bank, couldn't actually manage. It was impossible. Like the state was actually already weak, and it was difficult. So basically, the value of the money converged toward the cost of printing a fake note. So basically, to reduce the incentive, or to reduce the incentive for a fake money issuer to issue fake money, actually the value of what he was issuing was actually the value of the accepted money. So they were accepting only small note, and the small note had a given value, and it was going through this.
This is pretty brilliant. This is like Bitcoin. Everybody can try and mine, and basically it's the cost of mining that's dictating the.
But at the end of the day, you still have an issue, because it's not a currency which is in itself, I would say, capable of supporting the monetary system, and it becomes de facto dollarized, because somehow like you compare it to another benchmark, or in terms of goods or in terms of other currencies, but there is not this macroeconomic, I would say, instrument that the national bank or the central bank can actually use to change. But yes, to your point, it's a bit how the Bitcoin is actually working to some extent.
So should we go back to gold? Should just use gold?
It's still to me it's interesting, because it's a psychology question, and some in a sense is, are you comfortable with not really knowing the value of money, as long as it works and we can create wealth out of it and everyone gets a share of it and so on? That's the way we work currently. It's like a society. I think this conversation highlights like all of how this works is too complex for anyone to fully comprehend. I've never met anyone in this payment landscape that fully understands everything. There's always a moment, like there is a part they don't understand, which is not the case in crypto. Like in crypto, there are a few reliable people I have that I know that they understand everything on not every project, but like on the basics and so on. In the way society works, you cannot understand. So how, do you trust it as long as it kind of works? And each of us try to fix some part and try to shed some light on what's happening somewhere, and we advance with this. Or do we want something that's super safe? We know what it is. That's this gold or Bitcoin. Also, in the sense, to me, it's all part of the success of Bitcoin. To me, should be explained by psychology of like, the world is too complex for me. Please get me to something that's much simpler. I can almost hold in my hand. I feel better now, because otherwise I'm afraid of this word.
I think as humans, we have a tendency to simplify things. Like we really love simplifying what's complex. We would live in a nightmare of a world if we didn't have this tendency to simplify. And we wouldn't teach each other things also. Like teaching is simplifying also. So maybe Bitcoin was created from that envy of simplifying what was seen as too complex. All right. I think this is a good moment to end it. People can decide if they want to use Tradfi, Bitcoin, or gold, and they can tell us which one is better. But yeah, Clement, Xavier, thank you. Thanks a lot for this conversation.
Thank you very much for having us, David. It was really enjoyable. I hope we didn't go in too many directions, but I think it opens a few windows, and yeah.
Yeah, people can tell us if there's something we can do another episode together, if there's something that we should dig more into. But it was I learned a lot in this conversation, so I think it's going to be useful to others. It was useful to me. Yeah, thanks again.
Thanks. Bye-bye.
Thank you very much.